Hi everyone, and thank you for joining us for our on-demand webinar today and case study, Match Funding with Flexibility. My name is Andrew Palolo and I'm the Director of Member Strategies and Solutions here at the bank. And today we're going to discuss two types of advances that can be beneficial when looking to match fund or mitigate the interest rate risk of any asset spread purchases, but also retain some of the flexibility that you may get with shorter funding in terms of adjusting the amount or the pricing of funding as market conditions change. So those two advances that we're going to look at today are the member option advance as well as the symmetrical prepayment advance. So to start off, we're going to look at a long horizon and give some perspective to the ebbs and flows of asset yields and the types of spreads attainable through match funding using advances. So what we're looking at here is a chart. In blue, we have the yield on a 3 to 5 year investment grade corporate bond index. And in green, we have the spread from funding that corporate bond yield with a matched term advance. So as we look at the ebbs and flows, and we see that in periods such as in the beginning of 2016, the spread widens out as softness in the credit markets hit, and then it contracts over time. And then we see periods like the latter half of 2018 where the spread begins to widen out again, and then it comes back down. And then most notably and most recently, in March of 2020, at the onset of the COVID-19 pandemic, spreads went through the roof and nearly to 300 basis points on that spread, as asset yields and asset spreads blew out much wider than where advances were being priced. So this gives you some perspective of a transaction where interest rate risk is mitigated, liquidity risk is mitigated, and the return is boiled down just to the credit spread component. So looking at something on a shorter horizon that is prevalent in the market right now is that the exceptional efforts taken by the Federal Reserve and the quantitative easing programs is that it has calmed markets considerably. And one of the impacts of those actions is that the expectations for future interest rate volatility have come down significantly. And when we see volatility go lower, that means that the cost for options to hedge against that volatility go lower as well. So what we're looking at here is the spread on one of the advances that we're going to discuss today, the member option advance. And we're looking at the spread for that advance versus a comparable maturity treasury. So we can see that spreads did widen out as we got into the first part of this year when the pandemic did hit. But markets have calmed considerably since then, and the spreads have contracted pretty sharply. And the bars here are meant to signify the maximum and minimum spreads that we have seen over the last year, as well as the average. So we can see that not only have we come well off the maximum spread levels that we saw in the first part of this year, but we are very close to the minimum levels that we saw happen in the end of 2019. So, we mentioned earlier about how we're going to look at some examples, specifically how the member option advance and the symmetrical prepayment advance can provide some value and some flexibility. So here we've just annotated along with the classic advance curve from 0 to 60 months, where the pricing falls in line for these two types of advances. So you can see the symmetrical advance in the blue circles is priced at just 2 basis points above the comparable maturity long-term classic advance. And then the member option, we on the previous slide, we had looked at the 5-year maturity with a 1-year lockout. That's noted here, as well as 2 other structures, a 5-year, 3-year, so 3 years worth of lockout before the option kicks in, and then as well as the 3-year, 1-year. So to give a 30,000 foot overview of what these advances do is that the member option, as the name implies, affords the member the ability to contract the advance to prepay it at the specified call dates with no prepayment penalty. And the symmetrical prepayment advance works in a similar way in that you can prepay the advance at its approximate market value. So if and when we're in a higher rate scenario, there could be a potential gain received by the member for collapsing the advance. So we talk about the prepayment profile being a significant feature of the options afforded by these types of advance. So I just wanted to show from a visual perspective what those profiles look like and how they differ slightly from the classic advance. So in the top left, we can see here the classic advance where as rates move lower, that a prepayment fee becomes embedded into the advance. In a higher rate scenario, there is no fee. So the symmetrical, as we see in the bottom left, has a very similar profile in a down rate environment in that there is a fee to prepay the advance early. But in higher rates is where it differs from the classic advance in that not only are you not paying a fee, but you are potentially receiving a gain. The member option, on the other hand, has a similar profile to the classic advance in rising rate scenarios, but in down rate scenarios, as opposed to the classic where there is a fee to prepay the advance, on the call dates, if you were to prepay the member option advance, there is no fee. So let's look at an actual example, a little bit of a case study here, and show some of the numbers and as well as the logic and the thought process for why the member option is particularly attractive. So the question that we have to ask is, okay, well, we have this flexibility afforded as part of this advance. Why and when would I use it? So in order for us to do an analysis, we need to look at a couple different components of the curve here. So we want to look at, in the example we're going to use here, is a 5-year, 1-year member option. So that means a 5-year maturity, and then there's 1 year of lockout. And then at that point, that is the first call date where the member can elect to prepay the advance. So we're going to look at the 5-year, 1-year priced at 117. And we're also going to look at the 5-year classic and the 4-year classic priced at 79 and 68 basis points respectively. So what we have to do is in order to answer that question of how low do rates have to go in order for it to make sense to exercise the call, we need to determine what the break-even rate is. And the way that we can figure that out is, as you can see in the table on the left-hand side, the first step is to determine what we would have paid if we had taken a classic for 5 years. So 79 basis points across 5 years. Well, we know when we take the member option for the first year, we're paying 117 for that first year. So we subtract that 117 from the total cost of 395 that we would have paid for the classic across the 5 years. And then that tells us cumulatively what our break-even cost is for those 4 years we have left to go on the horizon. So that's 278. If we take that 278 and break it up so that we can convert that to an annual number, we get to 0.695. Now, what is interesting about this 0.695 is that rate is above where the comparable maturity 4-year rate is today of 68 basis points. So what does that tell us? That is due to the roll down in the yield curve. So many of us are familiar with the concept of roll down more from the asset side of the balance sheet, where You can buy a particular asset at a certain yield, and then as time passes, it can be priced at a premium, even though rates, quote unquote, didn't move. That's because it's now being measured versus a shorter point on the curve. So here's a case where the liability side benefits from not just the shape of the curve, but the cheapness of the option cost that we had looked at a few slides prior, such that if nothing happens to the yield curve and we fast forward 1 year, it would make sense to exercise this call. So you're paying less of a premium for a value that is closer to being in the money. So around that, let's look at keep looking at this example and showing how if rates were to fall, how much of a benefit you might have from taking out this advance and capitalizing on the flexibility it affords you from having the ability to call the advance, but still having the protection of the mitigating the interest rate risk from the longer final maturity. So in this example, we're gonna stay with that same structure, the 5-year, 1-year member option advance, and we're gonna talk about a $50 million amount. And then we're going to assume that at the first call date, 12 months prior, 12 months after initiation, the rates have dropped 25 basis points. So the decision is going to be made to exercise the call and then replace the funding with the going rate on the then 4-year classic. So it'll now be a traditional match funded transaction to maturity. So we know that if on the 50 million you had taken out a classic on day 1 at a rate of 79 basis points, then the total interest cost would have been just a shade under $2 million across the 5 years. If we look at the second option of if we had taken the 5-year, 1-year member option at 117, paid that rate for the first year, and then exercised the call because rates have gone down, and then replaced it with a 4-year classic at 43 basis points, we see a total interest cost of $1.445 million. So that works to 58 basis points. And what we can see is that the savings versus taking the classic advance were a little more than $500,000, 21 basis points in percentage terms. And the graph on the right-hand side shows us what the rolling funding cost was all along the way. So in green, we can see it's a flat 79 basis points if we were to take the classic, whereas the member option, we start out paying a higher rate of 117. But as we exercise that call and benefit from the lower rate environment, that rolling funding cost drops rapidly. And then at about the 2.5-year mark, about halfway to that 5-year maturity, it crosses over such that the savings start to kick in on the total horizon, and you're paying less and less as time goes on as you get to that 5-year horizon. So that was the member option advance, and now we'll look at how the symmetrical prepayment advance can work in a similar way, but in a different rate environment. So depending on what your outlook or your balance sheet conditions and needs may be. So here we'll take an example where we have a $25 million borrowing at a 5-year term. And for the symmetrical, that would be at a rate of 81 basis points, just 2 basis points higher than where the current classic rate is. So we fast forward 2 years, and the yield curve is 200 basis points higher than where we are right now. So in a higher rate environment, a liability that is at a lower rate than where the going rate is in the market is going to be worth less than the original par amount. And again, we have to put on our liability hat, not our asset hat. Well, in that environment, a lower market value is actually a benefit because we're talking about the liability side of the balance sheet as opposed to the asset where a market value below par is not a good thing. It's a good thing for the liability side. So in this instance, if we were to exercise the advance where there's a potential gain to be taken, off of the $25 million original par, you'd only have to pay back $23,787,500. So a gain of a little more than $1.2 million or 4.85%. So like we did with the member option, let's take a deeper dive into some of the arithmetic here and see how that actually translates into the total funding cost. So we're going to operate with those same assumptions here, where we take a $25 million 5-year symmetrical at 81 basis points. 2 years forward, we're going to shock the yield curve by 200 basis points, and we're going to assume that we exercise the call. Well, if we've that's all well and good to be able to take that gain, but we're going to assume that the balance sheet or a particular slice of the balance sheet still has a need to be funded, that there's still assets there that need to be funded. So we're going to assume that we're going to replace it with organic funding at 2%. Now this could be funding of any shape and size, but for this example, we're going to assume that whether it's a depository with deposits or an insurance company with internal cash generation can replace it with a non-advanced source, and we'll get to a little bit more about that in a second. So again, similar to the previous example, we can compare what the cost is versus if we had taken a classic advance and didn't have that flexibility afforded by the symmetrical. So for the symmetrical, we're going to pay 81 basis points for the first 2 years, and then we're going to collapse the advance and take a gain of 4.85%, and then for the final 3 years pay 2% or 6% cumulatively. So when we add all that up, the outflows of interest cost and then the inflows of realizing the gain on the advance, it works out to 277, and then if we convert that to what it is over the 5-year horizon, that works out to 55 basis points. So when we look at the graph on the right-hand side, it's interesting because the light blue shows us just the outflows of the interest expense, right? We pay 81 basis points to start, but then when that 2% funding kicks in at the 3-month mark, it starts to go higher and higher, and then over the 5 years, it's a cost of 152. Well, why would we pay 152 when we could have locked in 79 basis points or 81 basis points rather at the very beginning? Well, when we factor in the realized gain into the total funding cost, we can see that once we collapse the gain of 485, that the member has more money coming in terms of the realized gain than they have that they are paying out in terms of interest costs. So at the 24-month mark, the total funding costs are actually negative, and it doesn't even get to a positive interest cost until about the 3.5 year mark, because even replacing the funding at 2%, the impact of that realized gain helps to keep total funding costs low. So in this instance, when we replace the organic funding at 2%, the cost across the whole 5 years is 55 basis points. For illustrative purposes, if we wanted to get to a 0% total funding cost across the 5 years, and assuming the gain amount is going to be the same, then to solve for what that replacement funding rate would be instead of 2%, it would be just about 1.07. So in a scenario where the replacement funding can be at a cheaper source, then there is the possibility to even have negative funding cost across the 5-year horizon. So think about the great impact that that can have on the overall spread and income statement by entering in this type of transaction. So to wrap things up, we just want to look at the two products that we talked about today and summarize the benefits that they can afford to the member, as well as the relative value and the pricing afforded by some of the conditions that we're seeing here in the market. So, on the right-hand side, I think that tells the story right there when we look at what the combined prepayment profile would be for a 50-50 blend of the symmetrical prepayment advance as well as the member option advance, and comparing it versus the classic advance. So we can see that in a down rate environment that there's going to be less fee for that combination as opposed to the classic advance. And then if we get into a higher rate environment, there is the potential to realize some gains and reduce the total funding cost as opposed to the classic advance. So, time today. Please let us know if you have any questions or if there's anything that we can be of help with. My contact information is here, or feel free to reach out to your relationship manager and we'd be happy to have a discussion. Thank you very much and have a great day.